Hello and welcome back to the Deep Dive. It is Thursday, February 12, 2026. Now, I have a stack of documents here that, at first glance, looks like the world's most effective sleep aid. It's the Q4 2025 earnings report for Hyatt Hotels.
I can see why you'd say that. Earnings calls are usually just, a lot of executives congratulating themselves on a job well done while reading from a teleprompter.
Exactly. But we aren't here to read a balance sheet. We're here because this report is actually kind of a secret map. If you want to know what the global economy is doing right now, who's got money, who doesn't, and where the robots are actually taking over, you don't look at a bank. You look at a hotel.
That's a bold claim, but I completely agree. The hospitality industry sits right at the intersection of, discretionary spending, corporate budgets, and global mobility. It's a perfect barometer.
So today's mission is to unpack how a legacy giant has completely surgically altered its own business model to survive. We're going to talk about the K-shaped recovery of travel, where the rich are vacationing and the business road warrior is, well,
Missing in action.
missing in action. And we are going to talk about AI, and I don't mean write me an email AI, I mean agentic platforms that are effectively running parts of the company.
Yeah, the AI section of this report is honestly one of the most sophisticated deployments I've seen in the service industry. It's not just hype. It is structural change.
So let's dive in. The headline number is that Hyatt beat expectations. Their system-wide RevPAR.
And that's revenue per available room for anyone not in the industry.
Right. It was up 4% in the fourth quarter, but, that number is kind of boring. The real story here is what they call the asset-light strategy. They've been talking about this for years, but it feels like in 2025, they finally pulled the trigger.
They didn't just pull the trigger, they crossed the finish line. I mean, this quarter marked the completion of a massive transformation. The big news was the sale of the Playa portfolio to Tortuga Resorts.
And that was a huge deal, right?
Yeah, a deal worth roughly $2 billion.
$2 billion. Okay, so for the listener who thinks of Hyatt as a company that owns hotels, can you explain why selling your hotels is a good idea? Doesn't that mean you own, nothing?
It sounds totally counterintuitive, right? But think of it this way. Owning a hotel building is a massive headache. You have to fix the roof, you pay property taxes, you deal with local zoning, and if a hurricane hits or a pandemic shuts, travel down.
You're stuck with a giant, expensive, empty building that's just bleeding cash.
Exactly. It's incredibly capital intensive, high risk, high overhead. You're the landlord.
Right.
So Hyatt has shifted to being a brand manager. They sold the physical buildings, the bricks and mortar, but they kept the management contracts and the franchise agreements. So now someone else owns the building and deals with the leaky boiler.
And Hyatt just collects a fee.
Hyatt just collects a fee, a percentage of revenue, for letting them use the Hyatt name, the reservation system, the loyalty program.
So they moved from being a landlord to being, what, a royalty collector?
That's the perfect analogy. And Wall Street loves royalties. They are high margin, they're consistent. Hyatt is targeting 90% of their earnings in 2026 to come from these asset-light sources. Gross fees grew 9% last year to almost $1.2 billion.
Wow.
That is pure, durable cash flow without the messy reality of owning real estate.
It's a valuation play, isn't it? I mean, tech companies get these huge valuations because they can scale easily. Real estate companies get lower ones because buying buildings is hard. Hyatt is trying to tell the market, hey, treat us like a tech platform, not a real estate holding company.
Precisely. And they're proving it by returning cash to shareholders. Since 2017, they've returned $4.8 billion. It's like they're selling the furniture but keeping the house keys and charging people to enter.
I love that image. But, okay, fees only come in if people actually stay in the hotels. And this is where the report gets a little schizophrenic. It feels like a tale of two travelers.
It really is a divided world. If you look at the data, the winner is clearly the high-end consumer. Leisure transient travel, that's you and me booking a vacation, is up 6%. But luxury specifically, that's up 9%.
That tracks with the whole experience economy buzz we keep hearing about. People might cut back on a new car or a new couch, but they are not skipping the trip to Bali.
They aren't. In fact, if you look at Asia Pacific, excluding China, revenue was up over 13%. That is entirely driven by inbound international travel. The world has decided that Asia is the place to be, and they're willing to pay top dollar for it. It suggests that despite inflation or any economic noise, upper middle class and wealthy consumers are still feeling very secure.
But then we have the other side of the coin, the road warrior. The person in the mid-range suit carrying a roller bag flying to Cleveland for a Tuesday sales meeting.
Yeah, he's not there. or at least there are a lot fewer of them.
The numbers are brutal.
They are soft. In the U.S., business transient revenue actually declined 1% in the fourth quarter. And the weakness is specifically in what they call select service hotels.
The efficient, no-frills places,
Yeah.
a bed, a shower, mediocre coffee in the lobby.
That's the one. And this feels structural, doesn't it? This isn't just the economy is weird. This is Zoom. This is Microsoft Teams.
Right. I mean, we are 6 years past the start of the pandemic. If individual corporate travel was going to snap back to 2019 levels, it would have happened by now.
It would have. And companies have realized they can save a ton of money by cutting those check-in trips. The sales rep doesn't need to fly out just to shake hands anymore. You have CFOs looking at those travel budgets and saying, why spend $1,500 on a flight and hotel when a video call is basically free?
So the individual business trip is dying a slow death. But surely business travel isn't zero.
No, and here's the nuance. While the individual traveler is staying home, the group traveler is back.
Ah, so conferences, conventions, things like that.
Exactly. Large group travel is up mid-single digits.
So the suit is dead, but the lanyard is alive and well.
That's a great way to put it. People will travel for a massive event. Hyatt is seeing a huge boost from things like the upcoming World Cup bookings, but they won't travel for a single meeting. We crave the big gathering, the networking, but we've become very efficient about the small stuff.
Okay, so if I'm Hyatt and I see this trend, what do? I need to fill those rooms somehow. And according to this report, their answer is to double down on the people who do travel. The World of Hyatt loyalty program numbers were staggering.
It's their competitive moat. Membership hit 63 million, up 19% year over year. But here's the real insight you need to take away. Loyalty members now account for nearly half of all occupied rooms.
Half. Wow. That is incredible density. Why does that matter so much to the bottom line?
It's all about customer acquisition cost, or CAC. If I book a room through, say, Expedia or Booking.com, Hyatt has to pay them a hefty commission, sometimes 15 to 20% of the booking value.
But if I'm a loyalty member booking through the Hyatt app,
That commission is zero. It's a direct relationship. So every loyalty member is fundamentally more profitable than a random guest finding them on Google.
right.
And these aren't just casual members. The top tier members, the people staying 50 or more nights a year, their room nights grew by 13%. So Hyatt is successfully extracting more value from their best customers. They are creating this walled garden where once you're in, you just don't want to stay anywhere else.
But they need places to put them. I noticed something interesting in the pipeline data. Usually you see big hotel chains fighting for spots in New York, London, Tokyo. But Hyatt is building in places I really didn't expect.
This is a direct response to that loyalty data. They realized their best customers wanted to stay with Hyatt, but they couldn't find one in smaller cities. So 50% of their new U.S. signings are in markets where Hyatt previously had zero presence.
They're filling in the map.
They're filling in the map. They're using new brands like Hyatt Studios, which is an upper mid-scale brand, and Unscripted to get into these secondary and tertiary markets. They're basically saying, we will follow our loyalty members wherever they go, even if it's to a small town in the Midwest that historically wouldn't support a Grand Hyatt.
Okay, I want to pivot because usually when a hotel CEO talks about technology, my eyes glaze over. It's usually, we have a new app or digital keys.
Right.
But Hyatt CEO Mark Hoplamazian went on this surprisingly deep tangent about artificial intelligence. And he used a phrase that stopped me in my tracks, agentic platforms.
I caught that too. It's rare to hear a non-tech CEO use that term correctly. And it's even rarer to hear them explain how it's actually working in production.
So for the listener, can we unpack this? What is the difference between the chatbot I use to return a pair of pants and an agentic platform?
Great question. A standard chatbot, the ones we're mostly used to, is passive. You ask a question, it retrieves an answer based on a script or a database. It's a fancy FAQ page.
Right.
An agentic AI has agency. You give it a goal, and it can execute a series of complex steps, make decisions, and perform actions to achieve that goal without a human holding its hand at every step.
So it's the difference between asking, what is the weather, and saying, plan and book my entire trip based on these parameters.
Exactly. And Hyatt is deploying this specifically in their backend, using multiple large language models, OpenAI, Google, Anthropic, all working together in a private cloud. The example they gave was about group sales, and it's fascinating.
This is the RFP thing, right?
Right. So Hyatt gets about 1.5 million request for proposals every year for meetings and events. Hey, I need a conference room for 500 people in Chicago next March.
1.5 million, that's a nightmare.
It's a paperwork nightmare. Humans get tired, they miss emails, they prioritize the wrong things. So they built an AI that analyzes the incoming request. But it doesn't just read it, it values it. It looks at the dates, the room availability, the past history of that client, potential food and beverage spend, the profit margin, everything.
And then it prioritizes the high-value deals for the human sales team.
It pushes them right to the top of the queue.
It's Moneyball for hotel bookings.
That is a great analogy, and the results are real. They said group sales productivity increased by about 20%. That effectively saves the sales team an entire day of work every week.
That's not just efficiency, that's pure margin expansion. If your salespeople are only talking to high-value clients, your revenue per hour goes through the roof.
And they mentioned revenue per booking actually went up because the AI was better at spotting the upsell opportunities than a tired human might be. It knows exactly what that specific type of group usually spends money on.
They also touched on the consumer side, intent-based search.
For sure.
This feels like where the whole internet is going.
Yes. We've been trained to search like robots, right? Chicago. Hotel. May 12th. 2 guests. That's just database querying. Intent-based search lets you talk like a human. I want a romantic beach trip in February that isn't too crowded and has good vegan food.
And the AI understands the intent, romance, quiet, dietary needs, and serves up options that match the vibe, not just the keywords.
And Hyatt is betting big that this is the future of booking. They want to be the infrastructure that can handle that request. If you type that into Google, Hyatt wants to be the first result because their system understands the query.
It's impressive. But we have to talk about the weather, literally. The report mentioned Hurricane Melissa.
The reality check. The travel industry is always at the mercy of Mother Nature. Hurricane Melissa slammed Jamaica, and Hyatt had to close several major properties there.
So is this going to tank their 2026 numbers?
It's a headwind, for sure. They're estimating roughly a $10 million hit to earnings in 2026. That's not insignificant, but, and this is that long-term strategic thinking again, the CEO was almost optimistic about it.
Optimistic about a hurricane.
Optimistic about the outcome. Insurance covers the damage and the business interruption, so they don't lose money in the aggregate. But what they get is a forced renovation. When those hotels reopen in 2027, they will be brand new, top-of-the-line products.
So they take a small hit now to have the newest, shiniest hotels in the Caribbean just in time for the 2027 season.
Exactly. It sets them up for a massive year in 27. It's taking a negative event and flipping it into a capital improvement project paid for by insurance.
That's the glass half full mentality I guess you need in this business. So looking ahead to the rest of 2026, the forecast is, let's call it grounded.
It's a normalization year. They're projecting RevPAR growth of 1 to 3%. The post-COVID revenge travel boom is over. You're settling back into a standard, boring GDP-style growth.
And interest rates are still a factor. It's hard to build new hotels when borrowing money is this expensive.
It is, and yet Hyatt's pipeline is at a record high. 148,000 rooms waiting to be built. They're finding ways to get shovels in the ground, or more accurately, getting other people to put shovels in the ground while they sign the franchise papers. They mentioned that even though financing is tough, the demand for the brand is so high that developers are just finding a way.
So if we step back and look at this whole deep dive, what's the synthesis? What is the headline for Hyatt in 2026?
I think it's that Hyatt has successfully morphed. 10 years ago, they were a real estate company that managed guests. Today, they are a fee-generating, data-driven platform. They've offloaded the risk of owning buildings. They are riding the wave of the wealthy luxury traveler to offset the decline of the standard business trip. And they're using high-end AI to squeeze efficiency out of a very messy industry.
It's a leaner, smarter, and honestly a much more resilient company. They aren't just selling beds anymore, they're selling access to a network.
Absolutely. They've built a boat that can handle choppy waters, whether those waters are economic downturns or, literal hurricanes.
Listening to you talk about the AI negotiating those group rates, it sparked a thought. We have Hyatt's agentic AI valuing the deal and setting the price. On the other side, big corporations are building their own procurement AIs to minimize travel costs.
I see where you're going with this.
Are we moving toward a world where my personal AI negotiates my vacation with a hotel's AI, where the entire transaction, the haggling, the booking, the room selection happens between two software agents in milliseconds, and we humans are just the cargo?
That is the multi-billion-dollar question, isn't it? If the bots can agree on a price faster and better than we can, maybe we just show up and enjoy the pool. It removes the friction, but it also, I don't know, removes the human touch from the transaction.
As long as the robot knows I need a room with a view and a late checkout, I think I'm okay with that. That's it for this deep dive into Hyatt's Q4 2025 report. Thanks for listening, and as always, stay curious.